broadly on EM, and there are some idiosyncratic stories that we've been unpacking there around Mexico, India, South Africa. Is there an appetite amongst your clients and your colleagues to get more exposure broadly to EM, or has the door closed to that trade?
I think the most important thing that we think about at the private bank is not painting EM with a broad brush, right? That you don't have to have a very large allocation across every single country in EM. And when we think about it, we really try and identify the stories that we think are longer term, are structural, and that offer our clients kind of very attractive returns, whether it be from the equity space or from the bond space. And importantly, because of the countries that we're talking about today, it's really inflation-adjusted returns. And so India, I would say, if we're thinking about Asia, is one of those areas in emerging markets that we do think offers our clients really good equity exposure, particularly if you're thinking about Indian equities versus Chinese equities. We've been looking at that relative value for a long time. When I think about the FX and bond space, and we're thinking about the countries that we're talking about today ahead elections, Mexico is a place that offers a very, very high, Kriti, you mentioned that South Africa has the highest nominal returns on its bonds or yields, but Mexico has the highest real returns on its bonds, and that's what we really care about from an FX and bonds perspective. Where we've been watching the election has really been, at least from that perspective, is there anything being injected into the situation that is going to derail what's already a very positive story from a real return perspective in Mexico? Everything that we've seen, at least over the weekend, is a no. So we continue to think that Mexico, at least from, again, inflation-adjusted returns and FX perspective, is one of the best places to be in emerging markets if you're looking for those opportunities in EM.
Well, as we're talking politics then, how vulnerable is the US dollar to domestic politics, to US politics?
Yeah, so we do watch this very, very closely, and there's a couple ways that we can try and identify if there's any risk premium being built up in US assets ahead of the election. As of right now, if we think about just modeling the dollar against growth expectations or interest rate differentials, the fundamentals that should dictate that, if anything, the dollar looks maybe 5–10% too strong on those metrics. We'd expect that to really invert if all of a sudden there was increased fiscal risk premia or any type of political risk premia in the dollar. And so as of now, no, we're not really seeing anything like that. We do pay attention to it. If the dollar is going to weaken in our minds, it's going to be because of cyclical reasons. The U.S. economy slows. The Fed interest rate cutting cycle really comes into view. We think that can happen for cyclical reasons, but to us, that's kind of a late 2024 into 2025 story, not so much over the summer.
All right, let's bring it back to the G10 story, if we can. We're talking about the dollar. We're talking about it being at the whim of these elections. I'm obsessed, though, with the deficit story. We saw it with France getting downgraded on Friday, really talking about this budget deficit looming over their economy. It's a similar story in the States, especially post-election. It's the first thing that comes up for the new president. And I'm curious why the FX market isn't reacting to that, or perhaps is in terms of fund flows. What does that look like?
Yeah. Look, it's one thing to say that the U.S. fiscal trajectory is concerning, maybe unsustainable, if I can use that, over a very long-term horizon. But the dollar, you can't deny it, is at the very center of the global financial system. Yeah. And so whether we look at the dollar share of global foreign exchange reserves, over 80% of financial transactions just globally are conducted in dollars. 60% of global trade is invoiced in dollars. Because of the dollar's central role at the financial system, the U.S. gets a much longer leeway, right? For maybe in another country that had the same level of fiscal deficit, the same external deficit, if we think about that twin deficit in the U.K., it looks very similar to the U.S., but we probably see those types of concerns start to show up in the U.K. before we start to see it in the U.S. because of the U.S. dollar's role in the financial system. And so those are the types of things that we're trying to kind of parse as we look at this for our clients.
Sam, I'm glad you brought us neatly onto the UK. I'm assuming you're assuming it's going to be a Labour victory on July the 4th. I'm wondering how small a majority the Labour leader Keir Starmer would need to win in order to knock the pound.
So I don't presume to know anything about it, but the polling certainly looks in that direction. Look, I just think that the next government in the UK, regardless of who it ends up being, is going to be very fiscally constrained, right? And I think those are kind of the lessons and the scars learned from what we saw in the fall of 2022. And so we're really not expecting much in terms of fiscal expansion. If anything, there will probably be some fiscal consolidation. I don't think the political victory, one way or the other, is going to knock the pound, right? What we're really focused on, I could apply the same type of analysis that we look at for the dollar. Are we starting to see signs that the pound is trading either weak relative to fundamentals or vice versa. And no, the pound looks almost exactly at fair value when we think about cable based on interest rate differentials in global equities. If we started to see some of that premium start to build up, then that would tell us something about what the market thinks a labor victory might mean versus a conservative victory. Yeah. But honestly, the polls have been so consistent, and the fact, I mean, I don't think I'm going out on a limb by saying that the polls have been so consistent that the market's base case is probably a labor victory, and still you have not seen any signs of risk premium build up in the currency.
Is that the reason, though, for this low vol dynamic we're seeing in FX broadly? Monetary policy seems to be on ice. Elections, we're waiting for them to roll out. Even if there are volatility in the elections, there's really no room in budgets to do anything. What changes the vol picture in FX?
Yeah, I think it's global growth, to be honest, right? If we think about what's happening in the global economy, there's really two things. One, global growth is actually improving. Even though rates are at these levels, global growth is kind of based from the second half of last year and is improving. And what we tend to see when global growth is strong is volatility is low. At the same point, the tail risks to the global economy are really coming in. So you have strong growth, but because labor markets are cooling and inflation is coming down, there's no need for central banks to hike rates and destabilize it from the right tail. And so you have the left tail and the right tail coming down.
Right.
If something was going to inject volatility, I think, sustainably into markets, I think it would be a real significant cool down in global growth.